that looks like a classic bear trap. And bear traps and bull traps, to me, they're essentially failed signals because you have a breakout of a key support level, and then you have a reversal. Or in the case of an up market, a breakout above key resistance and then a reversal. Failed signals are more reliable, technically, than the signals itself. That's the reason why I wouldn't be negative and why that could well be a turning point.
Is there worse than market volatility behind us right now? Certainly, that's what a lot of traders and investors want to know. Jack Schwager joins us today. He is the best-selling author of the Market Wizards series of books. If you haven't read Market Wizards, if you're interested in the markets, I highly recommend you to check them out. Jack has interviewed some of the best traders and investors in the world over the course of the last 30 years, over a series of many books. Jack has recently updated his latest book, Unknown Market Wizards, so we'll talk about some of his additions to his latest work. Jack, welcome back to the show. It's good to see you.
Hey, thanks, David. Good to speak with you again.
Yeah, you were on the show late last year, and we talked about, last year there wasn't as much fear as there seems to be now. If you just take a look at something like the CNN Fear and Greed Index, which, for example, which tracks an aggregate of 7 fear and greed indicators, technical indicators, it's currently at extreme fear levels, which is, for me, a little bit surprising considering that the markets have rebounded. Let's just take a look at the charts. I'm going to show my screen now, Jack. So this is just the SPDR, the S&P 500 ETF. I'm actually just going to go to the S&P 500. So following the dramatic sell-off last Monday, markets have rebounded. Basically, the S&P has bottomed out around 5,100 to 5,400. I think just looking at this chart pattern, Jack, could you make the deduction that that this rebound is here to stay? This is a continuous uptrend that we're seeing.
Yeah, this particular chart pattern has a mixture, has really two strong contrasting things to it from the way I look at charts. And let's cover both of them. On the one hand, you have kind of what looks like a potential head and shoulders pattern and the breakdown and a pullback right now to the base resistance level of that pattern, and sort of a natural spot to get resistance. And that by itself would be negative. And if that was the only thing that I'm seeing here, I'd say that this would almost be, you can almost do a trade where you go short right here with a relatively close stop. However, there's an offsetting condition which is even maybe stronger, and it's one of the favorite things I like to look at in charts. And that the low we made, as you can see, is just a bit below the prior relative low, and just a one-day spike down, and then we had a sharp rebound. So that looks like a classic bear trap. Now, bear trap is when you have a market make a significant new low for a short time and just going below another meaningful low, and then rebounds. You get the reverse pattern would be a bull trap, and bear traps and bull traps, to me, which are basically failed. They're essentially failed signals because you have a breakout of a key support level, and then you have a reversal. Or in the case of an up market, a breakout above key resistance and then a reversal. And to me, and this is something I wrote about, back in 84 when I wrote my very, very first book, which was the Complete Guide to the Futures Markets. And there was a large part of that is technical analysis. And there's a whole chapter on this. But when I said then, and it's something which I still believe, which is now, 40 years later, is that failed signals are more reliable, technically, than the signals itself. So oddly enough, while bull traps and bear traps are failures, that's exactly why I consider them strong patterns. So that's the reason why I wouldn't be negative, and why that could well be a turning point. But like I say, you do have the offset of a potential top at it and the market at resistance. So if I had to pick a chart which has really strong conflicting factors, this would be a good example.
Before we continue with the interview, I want to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. I think, okay, so if I were to just take, let's say, an RSI indicator, and then let's say if I were to put Bollinger Bands here, if at what point do you make the deduction that the markets are oversold and bound and due for a rebound? Do you look at any indicators, technical indicators for oversold or overbought positions?
So I'm not an indicator guy.
Okay.
And since you brought it up, let me just say this, and I have done this work a long time ago, but something like an RSI as an example, you will actually do better. You will actually do better by doing the opposite of the standard theory. In other words, going long when the RSI is above 70 and going short when the RSI is below 30. That, if you applied it, you applied that consistently as opposed to doing the reverse, as opposed to, being a seller when it's overbought and a buyer when it's oversold, will do better. Now, you have transaction costs on both sides. I think doing the opposite probably would make money on balance. You'd actually have to do computer testing, whatever. But I would give odds that doing the opposite of what people use the RSI for would be better. And the reason for that is that, sure, you can get, and this is where people go wrong, because they look at things like an RSI, and their eye goes to tops and bottoms. To say, wow, here's the top, here are the tops, and the RSI was overbought, and here are the bottoms, the RSI is oversold. What the eye doesn't see is all those times where it was an overbought territory and just kept on going, and vice versa on the downside. So not only don't I use it, I would caution people not to use it, and I would say that to the point where I would literally rather do the opposite if I was doing it all the time.
Is that because when momentum is strong, either direction, trader psychology typically tends to pile in that direction some more?
Yeah, it basically is when do you get the RSI overbought and oversold? Typically, when you're in a good trend, and trends tend to continue over time, and once they're going. And you're basically betting against the trend. So now, if you have another reason, not just the RSI, so if you have a pattern where, let's say, the market forms some sort of a top, and then at a rebound, and then your RSI was overbought, and you're at resistance, well, that's a special case. But as a sole indicator, unless you're combining it with other things that are much more meaningful, it doesn't have value. So it's conceivable it might have value if you only use it in certain conditions. I wouldn't rule that out.
Okay, let's go back to the charts one more time. If you just take a look at what happened over the course of July, and if you zoom out, it just looks like a technical correction. Certainly the S&P has had greater corrections just in the last 2 years, right? So, it's kind of baffling why the VIX spiked up to 60, which is a level not seen since 2020, even though, like I just showed on the graph here, that level of correction by the order of 5-6% over 1 week is not, it's a substantial move, but it's nothing like we haven't seen since 2020. What contributed to this substantial rise in fear?
Probably complacency. The VIX has been down for so long, and actually, from an investment standpoint, because the carry is always working the wrong way. If you're long the VIX, you're constantly bleeding money, and it's been going on, since the last peak, and it's just a steady. So it's worse than you would get just by looking at the VIX, because this doesn't reflect the carry that you're losing month to month. If you were take continuous VIX futures, you'd basically have just a consistent long downtrend. So you probably had a lot of people just doing that trade as almost a carry type trade, and from the short side and losing and making money all along. And I would guess, and I don't know, I would just guess that probably there was too much money just playing that complacency trade and taking advantage of the carry, and just there's probably a lot of short coverage that magnified that move. So I would guess that that's what it was, but I don't know.
Do you look at or do traders that you've talked to look at the VIX at all as a leading indicator? I ask this because just to take a look at what happened over the course of late 2021 to 2022 and into 2023, the VIX traded relatively range bound during that time. However, during the same period, you saw the SPY continuously going down, right? So,
Yeah.
volatility hasn't increased during a major, if you want to call this a bear market, but correction phase over the course of a whole year. So from a historical, just retrospectively, it hasn't really been a good indicator for that time period.
Well, that particular move, right? That particular move is a way larger move than we had here.
Yeah.
I don't think. Well, I guess the jump in the VIX was probably less than it was recently, right? I don't know if you wanted to back to that chart.
Yeah, let's take a look here. Yeah, was it?
And so, maybe not. So is that big spike the move on?
Yeah, this was that big spike was a move on August 5th. Yeah.
But I'm saying the last one.
The last one was 2020. That was COVID.
Oh, okay, so you did have a meaningful.
Yeah,
you did have a meaningful spike there. Yeah. No, so that's what you would expect, basically. Yeah.
Okay.
I mean, this move was, given the limited nature of this last decline, this jump in the VIX would be larger than you would expect for that type of a correction. The correction wasn't that big, so that's why I say it was probably the market was just over positioned. But and again, I don't know. I'm just
if you were to,
I assume that was probably the composition of the market. There may have been just too much money playing this trade, always being short the VIX, which would have been a money machine until this last rally. Decline market rally in the VIX.
So I guess if this were to happen again, let's say if volatility spikes up dramatically in one day on a move downward on the S&P that isn't really as great as, let's say, 2020 or even or a prior crash, can you make the deduction or assessment that it's just overreacting?
You certainly can, but of course we have the benefit of hindsight now because the market rebounded, right? And of course the VIX came way down. But at the time, sure, that move seems very excessive to the decline, but you don't really know, and you don't know if the decline is going to continue. And
I understand.
Yeah.
In your experience, well, actually, just based on the conversations you've had, the best traders you've talked to, how do they usually react on panic days?
I don't know if there's a typical answer.
Maybe give some examples.
Basically, traders that I've interviewed view volatility as a good thing, as opportunity situations. A lot of them, one thing you can say, and this has come up in many of the interviews, is the strategies that the traders used, while different, had a characteristic in common, which was an asymmetry in the position. In other words, it's a type of trade where if they're right, they would make a lot of money, and they're wrong, they'd lose less. Now, the probabilities wouldn't be equal necessarily or obviously, but they prefer to do those type of trades. So the traders that I've interviewed would, even though this like being short the VIX is a thing that makes money most of the time, for those traders who would be involved in a trade or in a market like that, they would almost exclusively be looking at situations where they'd want to be long, but they wouldn't certainly want to be long most of the time, but they pick situations where they thought the market was prone for a reaction and would be positioned, they would take the long position then. So it would be a selectively long position in the VIX if that was the market where they were playing for the move, because it has that asymmetric quality. But like all option type trades, the big thing to keep in mind here is while they would almost exclusively be long optionality versus short optionality, you can't be long optionality all the time because that's a losing strategy. But the key there is you want to use the advantage of options, which is that the position gets magnified in your favor selectively. And that's where the real advantage comes in options. If you selectively pick those situations where the potential for a significant move in one direction is meaningfully greater than a significant move in the other direction, that's where you do the option type trade. And I consider being long the VIX an option type trade.
Okay, then what are some of the common mistakes that inexperienced or rookie traders make during periods of high volatility?
Well, there's probably a number. One that comes immediately to mind is that while sophisticated traders will adjust their trade, well, there's two elements to it. One, they may be taking deliberately periods of more risk if they're expecting a big move. They may, famously, as expressed by Druckenmiller, who was also quoting Soros, who he worked for and ran his funds, was talking about how Soros taught him to be a pig, when he really had a strong conviction to take a larger than normal risk. And those type of trading conditions can often be associated with periods of an increase in volatility. So on one hand, they may vary their risk size at sort of early in the move. But the other element of it is almost sounds contradictory, but it isn't. It's just a matter of when it's done. Is that when you've entered the higher volatility environment, such as say 2008, once these high swings were in effect, sophisticated traders will adjust their trading size for that increased volatility. That be on their normal trading size on normal type trades, not the trades they consider real rare opportunities where they might take a position. But once you have that environment in place, as I say, 2008 is a great example, they will be trading much smaller. And I recall, one interview where, on the Trader pointed this out, here saying that he would meet other hedge funds and they would say, well, I cut my volatility, I cut my position size in half. And thinking they were being smart, in risk control. And he said, you cut in half, the market volatility is up by 4 times. So effectively, they're still trading double risk. So smart traders will adjust for the fact if volatility is greater, then you have to be taking smaller positions to account for that.
I like to point something out to you, and for the viewers as well. This is the SPY, and I'm going to overlay that with the Japanese yen. So over the course of this is actually the inverse. I want to take yen over. There we go. So over the course of the last, I would say, year to date period, there's been this unusual. I don't know if it is unusual. I'll let you comment on this, but this noticeable correlation between the yen versus the S&P 500, and people have been talking about how this recent decline in the markets was related to the unwind of the Japanese yen carry trade. Is this a pattern that you've seen in the past, a correlation with foreign currencies and capital flows? Yeah.
Yeah, I don't know offhand. It's not something that I'm.
And by the way, if you just zoom out, if you just go back, this correlation just didn't appear in the past.
Yeah.
Consistently,
This is more of a recent phenomenon. But what I would say is, when you do have something like this occur, two markets which are going to the strong correlation phase, what is potentially significant is if they diverge in their correlation. And so if going forward you hit a period where the yen, let's say, goes down and the S&P goes up, or vice versa. The S&P goes down, a period where the S&P is going down, the yen's going up. If you
Yeah.
get a strong divergence, if you get the complete reversal of that correlation, then that type of reversal could be a signal that one of those markets is going to have a significant move. It's kind of a potential warning signal. This is something that came up in an interview with Scott Ramsey as a futures trader, and his point was, and which I agree, is that correlation is most useful when it fails, not while it's ongoing.
And this begs the question of what you do during a fire sale environment when correlations of assets all converge to one on the downside. Is there any safety for traders to go to?
What do you mean by safety for traders?
Anything, let's say when there are periods of panic and everything tends to go down together,
Oh,
gold, stocks, I guess in some cases bonds go up, but what do we do in that situation when the correlation of assets converge to
when
one?
everything goes to one, correlations go to one.
Yeah.
It's difficult because not only is everything going, everything's going in the same direction, but that also means there's a tremendous risk. So it's one of those situations where the risk is going phenomenally higher, and one of the things you always have to consider is not just the risk of the position you're in, but the risk of the portfolio. And if you hit these risk on and risk off periods where there's a lot of correlation between sometimes unrelated markets, you really have to keep position size smaller because your positions all the risk is going to go up and down together. So it's more a matter of risk control lesson than something you can do on the opposite side that is going to offset that. Sure, I mean, any markets that are behaving differently would give you some more diversification, but there may not be a lot of those markets.
I've been talking to some investors, and worries are piling up about geopolitical tensions, about the possibility of a Fed cut being negative for equities, uncertainty about election outcomes and what that could do for the economy, so on and so forth. I'm not saying we're going to have a bear market next year. I'm just saying that worries are piling up. But generally, when you're feeling skittish, what should you do to hedge? Do you advocate for hedging at all?
Well, it depends. Yeah. Basically, I'm more of the school of just worry, just define your risk on each position. And if there's a lot of correlation, have smaller positions. But, hedging in unrelated markets, well, insofar as if the trade makes sense by itself, but just overall, putting on a trade that offsets, that has no particular reason on its own, you could just basically reduce your exposure in the market rather than hedging in an unrelated market that you have no reason to be into.
During a bull market, is it difficult to beat the S&P
During a bull
500
market,
when everything's going up? Yeah.
yeah, I mean, if you're a stock trader and it's a bull market, by and large, the majority of people will lose. I mean, you can look at so-called professional traders who are hedge funds as a broad community. Forget about mutual funds. I mean, mutual funds, there's untold number of studies that'll show you that, I don't know what it is, 85%, 90% of mutual funds, don't beat the index. And that makes all the sense in the world because they are themselves the market, but there's costs involved. And, they're going in and out, there's those costs plus their fees. And it's only logical that they would underperform as a group. It's mathematically certain. And that's what you get all the time. So that's mutual funds. You say hedge funds, well, they're also going short and long, and you would expect maybe, well, they would beat the market. Well, return risk over very long periods, potentially that's probably true, but over, and I mean very long time periods, but even over 5 or 10 years, if you're in a bull market, hedge funds are going in underperform because basically they're not on average 100% long. They're less than 100% net long. And so even if they're good at picking as a group, they're still good at underperform the market. So yeah, I would say it is difficult to outperform the markets if we're talking about the stock market and you're an equity trader. And we're talking a bull market, as you premised.
There's a quote that you made, Jack. You wrote that there are a million ways to make money in the markets. The irony is that they are all very difficult to find. What did you mean by this quote?
Yeah, so this is one of those, that is actually not a quote from a trader. It's actually,
Something you said,
I
right?
wrote this
Yeah.
as one of the introductory chapters of one of the books. I don't remember which market wizard book. But my point was that I interviewed all these traders. I have 5 market wizard books, and just about everybody had a different approach, different than everybody else. I mean, yeah, you can find a few that may have had a common approach, but over that whole group of traders, it's incredible how varied the approaches were, and in many cases, diametrically opposite. I mean, you had people on the extremes of being pure fundamental analysts, and now, if you, in terms of strategy, and believing technical analysis was a bunch of mumbo jumbo. And you had the opposite extreme, people who were pure technical analysts and thought fundamental analysis was useless. And yet they both people in those categories were very successful. And so you have, and of course, within each category, the people who use fundamentals use lots of different approaches. People who use technical use lots of different approaches. Some people use both. So you have just tremendous variation. And so I said, my point was, when I said there's a million ways to make money in the market, meaning that it's not a matter of finding some magic formula. There is no magic formula. There are lots of different approaches that will work. But the irony is that they are all hard to find. Even though there are so many different approaches, to really, for a person to get one approach that works for them is difficult because most people don't succeed at it. And so that's what I meant by there's a million ways to make money in the market, but ironically, they're all difficult to find.
What about for the person, the layman who just wants to preserve wealth? He's not a professional trader or investor. Maybe he doesn't want to hire a hedge fund manager to manage his money. He just wants to park it somewhere where he doesn't want to lose cash or half his cash erode due to inflation over the next 15 years or so, right? Have you talked to traders and investors about that strategy? Wealth
Well,
preservation is generally
get
what I'm
into the
getting at.
difference here between investing and trading, and
Yeah.
also the difference between people who have a trading edge and are truly committed to trading as either a very serious hobby or profession, versus people who don't really have an edge and don't have any. There's no reason why they should do better than just blindly investing in an index. So I think the advice, and I've made this point. If I had made it in the last book of that, in fact, I at the ending, it's probably, if I recall, it's the very last chapter makes this point, and the idea is that there's this conflict between philosophies, whether people should try to beat the market, that markets can be beaten, and the efficient market hypothesis is incorrect, and I agree with that. And the belief that no, most people will be better off just investing in an index fund. And ironically, I believe in that too. And in fact, my point in that chapter was both camps are right. The difference is, yes, the markets can be beat, but it's only by a minority who have developed some approach that has an edge. For most people, and this is where the other philosophy comes in, most people would be better off just taking their money and putting it into a low-cost index fund like Vanguard or something like that. And over the long run, they will do better than if they try to trade the market themselves. Because if they trade the market themselves, they don't have an edge by definition, as we just said, and they're not going to do as well as just staying long the index. So that's the point. It's the difference between who the participant is and whether we're talking investment or trading. So those are the distinctions here.
We were taught all sorts of theories about diversification in finance and business school. The traders you talked to, how diversified were they on average? How many positions were they trading at any given time?
It varies considerably, but by and large, if people are going to outperform, by definition, they're concentrated traders. So I can't even think of an example of a trader I interviewed who was highly diversified, who had 500 stock positions or something like that. I can't even think of that type. I can't think of an example like that. Or maybe I can think of an example, but that was like a very short-term trader that was using This was a different thing. It was very short-term trading in and out. So other than that, other than people who were trading very, very short-term, I don't think, and even they as a group usually are concentrated. So by and large, no. I would
Okay.
say people who outperform the markets almost by definition are going to be somewhat concentrated.
Jack, thanks very much for your time today. Where can
Sure.
we learn more about you all? You said you made a recent addition to your latest book, right? Tell us about that.
Oh yeah. So this is the time I did the original Unknown Market Wizards, the the initial printing or release of the book was came out right before COVID, and so right after the book came out, we had the bear market from COVID. We had then this surprise quick reversal and this long bull market. And then about a year and a half later, we had another big bear market. It was kind of, it seemed seemingly like a tough environment and something that could have been detrimental to a lot of traders. So I was curious, how these traders had fared, and not only how they fared, but how did they navigate those really tumultuous financial times. So I went back, and this was coinciding with the release of the paperback version, which was about 2 years later, and or 2.5 years later. And I went back and they re-interviewed them, not in total, but just, hey, what happened in the period after we last spoke? And not maybe not surprisingly, I think all of them did. Some of them did spectacularly well, but I think almost all of them did well. Maybe all of them. They all did pretty well. And like I say, a couple of them had spectacular successes during this period. So I added for each chapter, I added an update section, which was an interview about how they navigated those times.
Okay. Well, I appreciate it. Thank you. We'll put the links to some of your books in the description. There's many
Sure.
books that you've written over the course of the last 30 years, but you're best known for the Market Wizard series. So thank you for sharing your thoughts with us today, Jack, and I look forward to having you back on.
Sure. Good to speak to you. Take care.
Thank you.